through the combination of the omnibus bills, the relief from insolvent trading, and as the states have worked through both the commercial and residential tenancy packages, it's been quite clear that taking that little, giving everyone that little bit of time to breathe, probably protect their mental health to a certain extent, and to regroup a little bit has been both a very powerful and useful tool for a lot of people. I think for most of you as accountants who would be listening in, it's probably been a little bit of an horrific time as well. Just having to deal with finding out a new $130 million bill and having 3 weeks to actually understand the law and help all your clients implement that law. So I think the accounting profession's probably been one of the ones that hasn't had any mental relief at all. And in some cases, from what I'm hearing, it's actually probably been a little bit tough. However, by providing the thanks, Elise. By providing the various bits of relief, it has certainly done a couple of things that I believe has been very helpful for businesses to have this little hibernation phase. Creditors and banks don't quite have the same ability as they used to have to chase, and with the insolvency laws allowing a 6-month window now effectively for both insolvent trading and their ability to chase debts, that's certainly given a lot of relief and reprieve for some people. The various stimulus packages, both at the state and federal level, have added to the cash flow and allowed people to stretch out what cash they have to try and make things last longer. And people being chased for their personal liabilities is either stopped or deferred during this period as well. The problem and I'm not someone that peddles fear, and our firm is certainly not someone that peddles fear, but what we are very concerned about is while people sit in this hibernation phase, if they sit there and do nothing and wait to see what comes out the other side, we're going to end up with situations where creditors will be able to start chasing again and potentially will chase very hard. Banks will start wanting to have the conversations around accrued interest and getting their money back. We, on a much smaller scale, in about 2011 when Queensland had their floods, the banks all did very similar things, and the banks are very good at giving people reprieve during hard times. But what we found was when that was over, they often chased extremely hard to start getting some of their money back, and that can put businesses under even more pressure than they were before anything actually happened. I also think that the demand on cash flow is probably going to be harder and tougher as things ramp back up. I was talking to a small cafe owner this morning in Queensland, and they were actually concerned that when they release some of the restrictions and actually allow them to open up again, they're probably only going to be able to open up at 20 or 30% of what they could do normally. And that potentially will actually put even higher demand, cash flow demand on them, because they're going to need more staff, but they're not going to have the ability to generate the income because of the limited amount of people that they're going to have in their shop at any one time. So all of these things will, after hibernation, will start having some fairly significant impacts, as well as people being able to chase personally. Thanks, Elise. I think what's really interesting in this time is that when you actually look at the COVID-19 is really treating businesses very much like it has treated individuals. If you're a healthy business before COVID-19, or if you're a healthy individual before COVID-19, and you were unlucky enough to contract it, there's a fair chance that you'll get through okay. Now, you might feel you'll feel sick and you might feel a little bit of pain, but you're more than likely going to come through the other side. Where we've had a focus is on protecting the vulnerable people because that will affect them more. The same is very similar for businesses. If you're a vulnerable business beforehand, and then you came into COVID-19, you're going to feel a lot more pain, and it's going to actually potentially, put the business into ICU and potentially be terminal for those businesses. So we see a lot of similarities around what should be done and what can be done precautionarily and protecting. And I think one of the best examples that we can see in the marketplace at the moment, which is open for everyone to see, is the example of Virgin. Virgin, I believe, although I'm not privy to the details of their balance sheet or anything like that, you'll see that they were a business that was in strife beforehand. They were fighting to be profitable, and coming into COVID's actually obviously put them into a very serious situation. But the board, without getting the reprieve from the government, were forced to use the corporate ICU of a voluntary administration to give them a chance to restructure, to reset their debt, to reorganise their positions, so that by the time they get to operate again, and once they get up and running and moving at their full steam, they will hopefully be in a much stronger position. Now, it's one thing for us to look at it on the front pages of the newspaper and the main press when you see these big organisations go through these restructures, as we've seen a lot of in the last 12 months, and I think we'll see a lot more of in the coming months. But one of the things that's really important to understand is that those opportunities for restructure and using both the formal and informal insolvency structures are very much available to medium, small and micro businesses. And it's important now to do a health check on businesses, to look at their viability, look at all their staffing and premise requirements, working out what they can do on a marketing front, what changes they need to make, and use this period potentially to look at various forms of restructuring. Most of you would have seen a lot of talk around the place of late around holding dockers, but there are a number of other strategies available to businesses that during this hibernation phase they can use to recalibrate their businesses and restructure their businesses in ways that will allow them to make the most of coming out the other side and being as profitable and as strong as they can moving forward. Thank you, Elise. I think today, although you could probably spend the next 5 hours talking about all the different areas that people should focus on, today I'm just going to focus on 3 main areas, getting for you to review with clients, and that is to have a look at the business structures, have a look at the finance and the credit arrangements of the business, and a little bit around financial management. So firstly, when we look at business structures, thanks, Elise. Some of the basic things that we see quite regularly that can cause a lot of businesses grief as they over time is their structures around whether they're a sole trader, working in partnership, or individuals of a trust. As most of you would be aware, the impact of that can lead to a lot of personal debt flowing onto the individual sole traders or the individuals trustees of trusts. The indemnities or the structures of a trust is a very powerful tool, but where the individual is the trustee, a lot of that protection is lost. Now, when we've spoken to people in the past over the years, there's a lot of desire. Well, there can be a desire to change people's structures. When you're doing that, when you've got a fully fledged moving business, can add a lot of complexity and a lot of cost. So when we're reviewing clients' businesses, if we are in a form of hibernation as we are at the moment, the ability to restructure a business into a more protected structure is almost a simpler method to do while we're in this phase. So having a look at your clients and working out whether they should be in a different structure, having a look at joint directorships and the personal guarantees that are associated with that are very important things that can be adjusted and dealt with now. You know, having a look at whether we need to have in a mum and dad business, if mum and dad both need to be the directors, Or can we have one as the director and the other one holding the shares? Is an asset holding entity something that is of value and can be used now? Is it a time now to restructure the trading part of the business out of the original entity, leaving the assets in what will become an asset holding entity, and trade the business moving forward through a new structure? These are all things that, as advisors, is a good opportunity now to have a look at and work out what can be done. Because I think from Hank's and my point of view, and from our whole team's point of view, there literally has never been a better time for business owners or directors to look at a recalibration and a restructuring of their business if required. Thanks, Felice. When we look at, then moving on to having a look at finance and credit arrangements, I think it's, again, we're in a very lucky time where banks aren't chasing debts very hard, and in a lot of cases, they're quite comfortable to roll debts forward for a few months to give people some breathing space. But one of the other things is we're finding they're not providing finance. I think that's been very clearly shown in recent times when everyone thought the banks were going to help provide JobKeeper income or money to businesses to pay the JobKeeper leading up to receiving the first monies, which I believe are due shortly. The banks weren't that eager to provide that sort of finance, and they made it very difficult. So for businesses now, the whole finance structure needs to be looked at in preparation for coming out the other side. Most of you have heard either Hank or I or any of the team speak, have often talked about fintech lenders and how much they've been jumping into the market. Of late, they've been very quiet, and we anticipate that they'll probably stay quiet for a little while. But that's something that you need to be mindful of, because they will eventually need to start chasing again because of the way they've structured their debt. Banks are preparing to write off a lot of debt and reduce dividends, which for us as shareholders is probably not great. But from the bad debt point of view, if we have businesses that aren't in a great structure, it is a very good time to be talking to the bank about what that debt structure can look like. Using this time to, again, recalibrate or restructure that debt and looking at what other options are available to the business moving forward. And although we see here that we've got the government-backed loans, we've found that they're a very hard thing for most people to get. And there's a lot of clients that have been talking to us assuming that they would be able to get access to that. However, they've been a very difficult loan to qualify for because of their 3-year repayment period. Not a lot of businesses are strong enough to be able to afford to pay back $250,000 within the 3 years, particularly if they're businesses that have been in that vulnerable phase. Thanks, Elise. The other side of finance and credit, I think, is really critical at this point, is to have a look at security. A lot of people don't like talking about personal property, the personal property security register, but getting a client to review what's registered against their company or against their ABN, it's a very critical time to do that, to work out who may or may not be able to come after them in the future. Making sure that if all PAPs have been satisfied and they're no longer required, that we get those charges removed from the company. And look at all the purchase money security interest or the PIMSs in place. The other, and doing that also, not just for the creditors that exist with the company, but also having a look at it from any asset holding entity point of view. What could be going on? Have they got the right asset holding entity and PPS leases in place to ensure that they're protected? I'm certainly of the opinion that I think a lot of businesses will come out of this very well and very strong, but I think clearly there will be some pain that will be seen. So ensuring that your clients are protected from the risk of other businesses falling over moving forward is a very important recheck and recalibration that should happen now. The other thing we're seeing is businesses are lending, or directors are lending them to themselves at the moment and putting money into their business to ensure that they can survive. Making sure that those directors or individuals have put the appropriate loans in place and have secured their loans where they've lent money to the business, and making sure that that's appropriately documented is a very important thing that should be looked at now. There are some really important dates and requirements necessary for looking at the timeframes for registering security. But if they've been missed already, there are things that still can be done, and that can be talking with our team will give you some ideas of what can be done to protect that. But certainly looking at all of those things now while we're in this quiet phase for however long that lasts, is important. It's a good review to have. And coming into the tax period now, I know a lot of advisors will be doing their tax planning, and taking the extra time to do these reviews a little bit beyond purely the tax, I think is critical for clients as we move through this period of time. Thanks, Elise. Now, on the financial management side, again, a lot of the stimulus packages have made some of these things relatively easy at the moment, that making sure that the BASs are lodged on time to ensure that we don't create any further director penalty notices through these cash flow periods. Given that to get some of the stimulus packages, you need to lodge the BASs, that's actually been a very good thing. As a reminder, most people would be or may have been aware that on the 1st of April, the director penalty notice regime extended to now include GST, wine equalisation tax, and luxury car tax. So now more than ever, it's important to ensure that all of the clients' reporting requirements are kept up to date or brought up to date, and potentially even having a review of the last couple of years if there is some outstanding tax requirements. Again, the ATO has been very generous on giving people time, but if we are struggling to be able to deal with that time, working out whether there are any director penalty notices that may become a problem in the future, it's a very good time to review those. Having clients review their personal guarantees that they have with all of their creditor list at the moment is, again, a very good thing to do. And over the years, you would have heard Hank and I both regularly talking about having a personal guarantee register. Often it's one of those things that people will like to get to at some time. Again, using this recalibration and this hibernation time, there is a very good opportunity now for people to have a look at their creditors list, have a look at their security list with their all-paps and their PIMSs, review that with their credit applications that they would have done over the years with their creditors, and put together a register of personal guarantees and what security has been provided against that. So if the client was to get into trouble in the future, we can very clearly know where the real pain and hurt points for the director personally can be. Again, a very good thing to look at now is your Division 7A loans and any unpaid present entitlement loans, and making sure that they're managed and being looked after. A good review of that is worthwhile doing at this time. The other big thing that we see that often causes trouble for businesses if they do get into trouble is their debtor-creditor relationships, particularly between their related entities. We've seen many a good structure over the years where you might have a staffing entity, a asset holding entity, and the trading entities all operated separately for good protective reasons. However, if the transactions rolling between those three entities aren't being dealt with properly, and directors are just moving money around as they see fit, which is often happens, then those relationships, when the company gets into trouble, can actually create more problems than the structure would have protected in the first place. So it's really important for now to make sure that if you do have clients who have multiple corporate structures, that the transactions occurring between those are being properly documented and the payments are being made against them, and you're not creating massive debit or credit, debit or creditor relationships in place. And have a looking at holding entities, asset holding entities. Are they structured? Do you have appropriate agreements? We see a lot of businesses with asset holding entities in place, but there's no PPS lease in place. Are the agreements structured correctly to ensure that if something was to go wrong, that the asset holding entity will actually do what it's designed to do and allow businesses to be protected? Thank you, Elise. So I think I would love to be able to sit here today and tell you that I have a crystal ball and know exactly what's going to happen in the post-COVID environment, how quickly everyone's going to come out, how quickly people are going to start making money again. But we all know that there is a lot of unknowns. I think really what Hank and I wanted to express today in this short case study is that this is in this short webinar, is that it is a very good opportunity, as I mentioned before, probably the best I've seen in any time frame for a business to do a little bit of a review with their advisors and work out what to do. We don't really know how banks and other financial institutions are going to act on the other side of this, but being prepared is always good. Knowing how aggressive creditors can be. In some cases, I think you'll see the day that the 6-month rule is over, people will start getting slapped with creditor stat demands and bankruptcy notices straight away. Others will still give a lot of time and give some space for people to do things. And the other, again, I think one of the big areas across the country that is a very big unknown is how the rents obligations are all going to play out, both in the short term and in the long term. A lot of businesses run a very high percentage of their total turnover is rent-based, particularly in the retail space. And a lot of the code of conduct, right, basically is almost going to add 30 or 50% on top of current rentals as they come out the other side. Now, if businesses were tight already, that's going to be a very, very challenging thing for a lot of businesses. Taking the time, thanks, Elise. I think the one thing that we, both in COVID, pre-COVID and what will be post-COVID, is that having a plan B for a business is really imperative. Making sure that you take the time to review the position, come up with some opportunities, work out what things can be done. As you know, we've got a very, very strong and knowledgeable team across the country that specialises in looking at what the Plan B option can be for businesses. Again, for some of you, you would know that we provide that obligation-free Plan B scenario for businesses for you all to review with your clients. Taking that time now to look at Plan B options for clients, I think there is no better time, and it is a great opportunity to ensure that coming out the other side, businesses are structured as best they can be to work their way through. And part of our Plan B will look at all the structures, look at loans, directorships, all those things are all very critical things to be done. I think it's a very short presentation today. I know some people will spend hours talking and moving through things, but for us, we just wanted to give you a very a brief rundown on some thoughts for us to look at. I think it's really critical and a very important thing for all businesses to look at is to have a look at that Plan B. So as you're working through your clients over the next period of time, don't be afraid to pick up the phone to myself or Hank or any of our strategists around the country and just talk through some of the options that may be available. I'll now open up the chat room. I think Elise is going to look after that for me. And we can talk through any questions that anyone might have at this stage or any thoughts or concerns that they're seeing in the marketplace or anything that they would like to bring up or talk about at this point. Elise, I can't see the question box, Elise.
We don't have any questions at the moment.
Oh, there you go. We'll give everyone a bit of time if there's anything they'd like to ask, or just general things around PPSR or loans. Any comments they'd like to say about what they're seeing in the marketplace? All right.
If anyone there's one from Damien O'Donnell. Do you think these new government-backed up loans are actually a good idea?
It's a really good question, and I think it's very business specific as to whether they're a good idea or not. I think if you have a business that needs, particularly if they're going to need to restock or restaff themselves from a cash flow point of view, and they can turn that around and turn that back into cash very quickly, I think it's potentially a very good loan. Because it is that government backed. But even though the government's backing it for 50%, the directors of whoever takes out the loan are still going to be personally liable 100%.
Awesome. We have Gary Stack with hand raised, so I'll just unmute there so we can hear the question.
Hi there.
Hey, Jerry.
I'm curious to see how this plays out post-COVID in terms of restaurants and cafes, because if restrictions are going to be such that space has to be more spread out and limited, then fundamentally that's where your profit is going to disappear. So a lot of these places may very well not survive in business post-COVID. Yep. Under the benchmark provisions, generally speaking, a restaurant would spend about 30% of its turnover on COGS, and then you've got a significant amount of turnover that goes to rent and staffing. So the balance of the money, the profit that comes out of it, is basically is largely dependent on numbers and throughput. So if you're restricted, therein lies a problem.
Completely agree with you, Jerry. As I mentioned, I was talking to a cafe owner this morning, and they've been able to convert to a certain extent to take-home meals and coffees at the moment, but they can do that with the two owners on their own. If they're required or asked to open up or allowed to open up, and this is a Queensland-based one, and that's potentially on the cards over the next few days, they're actually very concerned to open up at 30% if the 4 metre rule is still a rule that they have to stick to. They will have probably space for about 35% of the covers that they would normally be able to do. So that almost makes it less profitable than if they stayed shut.
Okay, we have a question from Stephen Smith asking the best options for restructuring Div 7A loans in the current situation.
At a very high level, the answer to that is that some of those Division 7A loans can be secured. So you can look at actually securing some of those loans just to give some added protection if need be. The other thing is to actually look at, given that there's probably going to be some drop in wages coming through, if there's a way of actually putting that through to wages. But obviously that depends on a whole number of factors, and it needs to be reviewed on an individual basis as to what other options are available.
Then we have a comment from Brian Daly. If directors have already advanced funds without documentation, are they doomed in an attempt to take security after the event?
Again, a very good question. They do lose a level of security in the short term. So if the director has lent money to the business and outside the 20 days and we haven't secured, and it hasn't been secured correctly, you still have the ability to secure that debt post the 20-day period. However, if the company was forced into liquidation within the 6-month period, that security will be deemed to be green and would not stack up in the case of an insolvency event. However, if an insolvency event doesn't occur, then that security gains strength and value over time.
Then we have a question from Kerry Farley. Just generally, do you feel many businesses are putting their heads in the sand about not paying their rent at the moment, not realizing the implications in 5 months' time, especially those businesses in the hospitality sector and those businesses supplying to hospitality, which is obviously one of the hardest hit sectors?
Look, yes, I think, I think at a higher level, when you look at rental scenarios everywhere, there's a lot of people who I think have taken I've got the opportunity, whether it be loans or whether it be rent, that they've taken the opportunity to defer when they haven't really needed to. So obviously a hospitality business, if they've got the ability to pay the rent or do a better deal, in some cases recently we helped a client who didn't take the 50% or the discounted rate away, but the landlord was willing to provide just a reduction in their rent. So that was a good negotiation to do because they're still paying some rent without any further impact on them later on. But do I think some people are probably using it inappropriately? Yes, because it will come back and bite them with higher rents later on.
Gary, I'll get back to you very shortly. And meanwhile, we have Graham Scott. Ashley, do you have a sense of when we will start to see distress in the market in terms of increased number of external appointments?
That's one of those crystal ball ones, I think. There's a number of different viewpoints on when that time frame may start to kick in. I think there'll be some people are saying that once everyone's stopped looking at the stimulus packages, I think for the last month or so, any business that I've spoken to, or even businesses that were in distress that were talking to us before COVID, have put themselves in a little bit of a holding pattern waiting to get the money. So there's some areas of our industry that would say that once they realise that the money that they're getting from the cash boosts and JobKeeper and any of the state government incentives, once they come through and they realise that that's not going to solve their problem, you'll start to see an increase then. There is another school of thought that the real heavy increase in potential insolvency won't come until the end of the JobKeeper, that 6-month window that everyone keeps talking about and the government keeps talking about. I think when the hammer is lifted off the what is deemed the end of the pandemic period, so that at the moment that's sort of said, I think what the 29th of September is the end of that cycle. I think there's a large school of thought that things will start picking up then. So I think there's a combination of both, but from a crystal ball point of view, it's very difficult to see where it will come. We have an opinion that some of those who start thinking like we're talking about in this seminar to start redoing and restructuring themselves now, you'll start to see a pickup then.
We'll have a question from Leonardo Rodino. How will defaults, debt agreements, and bankruptcies be reported to personal credit files during this COVID period?
Sorry, Elise, I'll just get you to repeat that question.
How will defaults, debt agreements, and bankruptcies be reported to personal credit files during this COVID period?
Well, the defaults, if they can issue a default, which technically a default can still be achieved at this point, that would still go through the credit file. There's nothing that I'm aware of in the insolvency changes that will stop a default being lodged technically. Bankruptcies, if they weren't in the late phases of the bankruptcy before the change in law, then they don't have the ability to bankrupt someone for a 6-month period. So that obviously, if you can't be bankrupted, it won't be reported. But certainly defaults, there's nothing in the legislation that I'm aware of that would stop someone issuing a default. And then if they did issue that default, it would still roll through. Now, a lot of the financial organisations are not issuing the defaults because they are giving the deferrals and providing that relief at the moment. But that's an individual case-by-case basis.
I'll get back to Gary Stack. I'll just unmute him.
Hello, Ashley. Again, coming back to the cafes and restaurants and so on. After the the 6-month relief package that we have, there's going to be, I think, a couple of things which are going to occur. Some businesses may very well remodel themselves and make it, and others won't. As you said earlier, some are maybe using the rent relief position, at a time when they shouldn't be. And when you come to the end of this 6-month period, some of those businesses may very well not make it.
That's
and then go under. And
Yes.
as a result of having rent relief and then going under, you've got a landlord losing, a bank losing, and you've got the proprietor of the cafe or restaurant losing.
Yes.
Now, if you have enough of those, the way I'm seeing it is that there could be a significant amount of commercial real estate become available and unable to be occupied. And given the way that COVID is going and the way people are remodeling the way that they work, companies are reinventing the way their staffing are working, a lot of more people will be working from home, you may very well have quite a significant amount of commercial real estate become available and unable to be used. What are your thoughts on that kind of a future?
Jerry, that's I think some of, and I don't pretend to be an expert in the commercial real estate market, but again, I've read a number of things like a lot of other people would have, that would say that is certainly on the cards. So I think that there is a belief that the value of commercial real estate will fall on the back of this. But I think, as I said in the presentation, the crystal ball is a very difficult one to pick at this time. I think there is, unfortunately, there will be fallout from this, and some businesses won't survive. And that's, again, looking at it from the personal versus business point of view, is that there are vulnerable businesses that won't make this through, and that will have impact on cafes and restaurants. And look, I think it will have impact on professional services that haven't been able to move through. We're seeing a lot of the big end of town have had to cut wages and staffing because people just aren't going to have the money. We've got a client that we're working with at the moment that's in the commercial lighting space, and people aren't going to have the capital methods to go through with any updating their lighting for a bit longer. So that will put them under stress. So I think and I'm very mindful that there are a lot of people here listening, and I don't pretend to be an expert in commercial. I think there's no doubt that there will be an impact in that area. But I don't pretend to know all the triggers that make that all work.
Then we have a question from Ryan O'Shea. And there's a question that CAANZ, so that's Chartered Accountants Australia New Zealand Audit Conference, clearly said that a 12-month budget is likely not enough to reliably show how a business is coming out of COVID. What are your thoughts on what's a reasonable time frame to judge how a business will come out of COVID?
I'm getting asked some really tough questions here. Look, I think that there's probably there's the short term, making sure you survive on a month by month basis through, I think if I even look at when Hank and I are looking at our business, even our marketing requirements, our business requirements are changing on a weekly or monthly basis at the moment. So giving yourself the room to move on that short term, I think is critical. I think most people are actually talking that the upside of this is going to be an 18-month process. Particularly, for those industries that have got any connections to the international market. So I think, in a really, in a perfect scenario, you'd be looking at 2 to 3 years out. But there are a lot of assumptions that would be changing. At the moment, I think some of the assumptions are almost needing to change weekly. But I think just as my personal opinion is that we're not going to go back to the same. And I've, unfortunately, over the years, we've seen a lot of people and businesses assume that we're going to go back to the normal, whether it was after. For some of you know the experience that Hank went through on the back of 9/11 with his businesses, through the GFC and all those things. Everyone assumes that we're going to go back to where we were before. The reality in my mind is that it's not going to be a new normal. So planning budgets 2 to 3 years out is going to be very, very difficult. But in a perfect world, that's what you're going to be trying to achieve, is to start having plans that allow you to look at that with regular adjustments as required.
Then we have another question from Brian Daly.
Sorry, at least before you can, those who would like to ask verbally, I'm happy for you to unmute and just do that rather than by the checkbox if you want as well.
So if someone wants to ask their question themselves, just raise your hand in the participant options, and then I can unmute you then. In the meanwhile, if a landlord is forced to defer rent under COVID-19 arrangement, can he take security from the tenants and guarantees in addition to that which he presumably holds?
Depends on what. Short answer is I actually don't know, because each state has ended up enacting their own rules around how to deal with it for each state. So in terms of their ability to increase security, my understanding at a high level is no, but you would have to look at it on a state-by-state basis, because each legislation has been drafted by the states.
Then we have one more question from Diane Nanda. Banks are providing unsecured loans, but believe director is a guarantor. If the business is broke, is director personally liable? How does it impact to director?
So if the unsecured loans are put in place, and there's no GSA on the company, but there is a personal guarantee, if the company does fall over, the bank will have the ability to chase the director for the shortfall. Now, what their ability to chase generally is like any other unsecured debt or any personally guaranteed debt. They would have to go through a statement of claim process, obtain judgment, and then go through the bankruptcy process if it isn't a negotiated settlement beforehand.
We don't seem to have any further questions, and there are no hands up either.
There we go. Okay, well, I think I'd just like to finish with thank you all very much for coming along. It's certainly a brand new experience for me, so be kind if you provide any feedback. But I thank you all for coming along. Please feel free to give myself, Hank, or any of our team a call if you would like to if you've got any more detailed questions or personal questions. And I think, as is often becoming a catchphrase out there now, all please stay safe and stay healthy. And all of you both, I think, just finishing up, please make sure you look after yourselves and your businesses while you're looking after everyone else at the same time. Apart from that, everyone, thank you very much for coming along and have a wonderful day. I think that's it, is it, Elise?
Yep.